Something happened inside the American banking system over the last 14 months that most retail crypto holders have no idea occurred. Not one announcement, not one headline. A slow, deliberate, documented series of regulatory reversals and institutional moves that, taken together, represent the most significant green light the banking industry has ever received on digital assets. And while retail holders have been watching prices drop and debating whether to sell, the largest financial institutions on Earth have been quietly positioning for what comes next. I am going to walk you through exactly what changed, who moved first, and what it means for where this market goes from here. Not financial advice, this is the documented regulatory and institutional picture that most people are missing. Let us start at the beginning, because to understand why the green light matters, you need to understand what the red light actually looked like. From 2022 through 2024, the federal banking regulators, specifically the FDIC, the Federal Reserve, and the Office of the Comptroller of the Currency, the OCC, issued a series of supervisory letters, guidance documents, and interpretive restrictions that effectively built an invisible wall between traditional banks and the crypto industry. Banks wanting to engage in any digital asset activity needed pre-approval. They faced what became known as non-objection requirements, meaning they could not move without explicit regulatory sign-off. The FDIC sent pause letters to approximately 24 banks instructing them to halt crypto-related services indefinitely while demanding extensive documentation. The Federal Reserve issued letters requiring banks to get formal approval before engaging in any crypto activity. The OCC issued Interpretive Letter 1179, which created significant operational restrictions. The practical effect was that any bank considering crypto custody, crypto payments, or stablecoin infrastructure had to run through a regulatory gauntlet with no guaranteed outcome, no defined timeline, and no clarity on what would ultimately be approved. Most banks quietly decided the liability was not worth it and stepped back. Retail holders felt the consequence of that in market prices. Institutions that could navigate the environment accumulated. Then, everything reversed. In a compressed 14-month window beginning in January 2025, here's what happened at the regulatory level, documented and sequenced. January 23, 2025, President Trump signed Executive Order 14178, directing all federal agencies to immediately halt and terminate any plans related to a central bank digital currency. Simultaneously, the same order declared that federal policy would favor the responsible growth and use of digital assets and blockchain technology across all sectors of the economy. March 7, 2025, the OCC issued Interpretive Letter 1183, reaffirming that crypto asset custody, certain distributed ledger technology activities, and stablecoin operations are permissible for national banks. In the same action, the OCC withdrew from the prior joint interagency statements that had established the cautionary barrier restricting bank crypto activity. The non-objection requirement was gone. Banks no longer needed prior regulatory sign-off to begin engaging in permitted crypto activities. March 28, 2025, the FDIC issued Financial Institution Letter 7-2025, enabling state non-member banks to engage in crypto activities under standard risk management with no prior notification requirement to the FDIC. This formally reversed the pause letter framework that had choked off banking access for 30 or more crypto entities. April 24, 2024, the Federal Reserve withdrew Supervisory Letters SR 22-6 and SR 23-8, shifting crypto oversight to routine supervision for state member banks. No more special pre-approval process, no more elevated scrutiny applied exclusively to digital asset engagement. Crypto became regulated like any other banking activity under standard safety and soundness principles. May 7, 2025, the OCC published Interpretive Letter 1184, confirming that national banks can buy and sell assets held in custody at customer direction, and that they can outsource crypto activities like custody and execution to qualified third parties. This opened the door for every major bank to begin offering crypto services through established service providers without having to build proprietary infrastructure from scratch. July 18, 2025, the Genius Act was signed into law, creating the first federal regulatory framework for stablecoins in United States history. Banks can now issue stablecoins. They can accept stablecoin reserves. They have a defined legal framework for an asset class that was previously operating in legal ambiguity. December 9, 2025, OCC Interpretive Letter 1188 confirmed that the execution of riskless principal crypto asset transactions on behalf of customers is a permissible banking activity. In plain language, a bank can now act as a broker for crypto transactions between clients without holding the asset on its own balance sheet. December 12, 2025, the OCC issued conditional approvals for 5 national trust bank charter applications from crypto-native firms. The OCC received 14 de novo charter applications in 2025 alone, nearly matching the total from the prior 4 years combined. April 1, 2026, a new OCC rule took effect, expanding what national trust banks can legally do with digital assets, specifically resolving legal ambiguity around non-fiduciary custody. April 2, 2026, the very next day, the OCC granted Coinbase conditional approval for a national bank trust charter, making it the first publicly traded crypto exchange to receive federal banking authorization. Coinbase joins Anchorage Digital, BitGo, Ripple, Circle, Crypto.com, Stripes Bridge, and Protego in holding federal banking authorizations. Morgan Stanley filed for its own dedicated digital asset trust charter in February 2026, one of the most significant moves from a traditional Wall Street institution in this space. Citibank is targeting 2026 for crypto custody service launches. Revolut submitted its application in March. That is the regulatory picture. Now let's talk about what the banks themselves are actually doing with the green light. Goldman Sachs disclosed $2.36 billion in crypto exposure in its Q4 2025 Form 13F filing, $1.1 billion in Bitcoin, predominantly through BlackRock's iBit, $1 billion in Ethereum, $153 million in XRP across 4 separate ETF products, $108 million in Solana. The bank that publicly called Bitcoin unsuitable for conservative portfolios in 2020 now holds $2.36 billion in digital assets in its registered investment filings. It tripled its Bitcoin ETF stake in the months prior to the latest filing. Goldman also added dedicated crypto equity research roles and expanded derivatives and crypto lending services to institutional clients. JP Morgan announced in October 2025 that it plans to accept Bitcoin and Ethereum as collateral for institutional lending, initially through ETF-based exposures with plans to expand to spot holdings. JP Morgan's Kinexus platform is piloting tokenized deposit and stablecoin-based settlement tools. The bank partnered with Coinbase to allow its 80 million Chase credit card customers to fund crypto wallets and buy crypto directly from their Chase accounts starting in the fall of 2025. JP Morgan launched a tokenized deposit token on Coinbase's Base blockchain, marking the first time a major U.S. bank issued a deposit token on a public blockchain. State Street, BNY Mellon, and Citibank are all actively testing stablecoins and blockchain-based settlement systems. BNY Mellon, the world's largest asset custodian with over $50 trillion in assets under custody, received SEC approval to custody digital assets in 2023 and has been expanding that service to institutional clients. The institution that safeguards the majority of the world's investable assets is now building crypto custody infrastructure. Here's the number that frames the entire institutional picture. Bitcoin ETFs now hold approximately 1.36 million Bitcoin, representing approximately 6.5% of the total Bitcoin that will ever exist. BlackRock's iBit holds over 550,000 Bitcoin. These are not speculative positions. These are structured, regulated, institutionally managed products through which pension funds, endowments, registered investment advisors, and sovereign wealth funds are gaining Bitcoin exposure at scale. Q1 of 2026 alone added $18.7 billion in net crypto exchange-traded product inflows globally, with Bitcoin ETFs absorbing $12.4 billion during that single quarter. Bitwise projects that ETF demand in 2026 will exceed all new Bitcoin, Ethereum, and Solana being created by miners and validators combined. That's a supply shock dynamic that has never existed in crypto's history. Previous bull cycles were driven by retail exchange buying and leveraged futures. This cycle has structured institutional demand absorbing supply through regulated vehicles at a rate that mathematically exceeds new production. Now let me connect the regulatory picture to the asset-level picture for XRP, XLM, HBAR, and the ISO 20022 aligned assets specifically, because this is where the green light becomes most directly relevant.
The OCC has now confirmed that crypto custody, stablecoin issuance, blockchain settlement, and riskless principal transactions are all permissible banking activities. The Genius Act has given stablecoins federal legal status. The Clarity Act, targeting a late April Senate markup, would convert XRP's commodity classification from regulatory guidance into permanent statutory law. Goldman Sachs disclosed $153 million across 4 separate XRP ETF products in its Q4 2025 filing. Standard Chartered, one of the world's largest trade finance banks, has live on-demand liquidity operations using XRP for its Middle Eastern and Asian payment corridors. When the largest banks on Earth receive regulatory permission to engage with digital assets, they do not immediately engage with meme coins and speculative tokens. They engage with assets that have regulatory clarity, institutional infrastructure, and documented real-world use cases. XRP has federal commodity classification. HBAR has a 31-member governing council including Google, IBM, Boeing, and Deutsche Bank. XLM has the Genius Act licensed RLUSD equivalent in the form of a direct federal commodity classification and CME futures launching May 29th of 2026. These are the assets positioned at the institutional end of the digital asset spectrum. The question in the title of this video is whether you are positioned, and the honest answer requires you to do your own math on your own situation. But here is the framework every institutional decision maker in the space is using. When something moves from being unbanked to being bankable, the addressable capital pool expands by orders of magnitude. Crypto in 2022 was effectively unbanked. 30 or more entities lost banking access through informal regulatory pressure. The FDIC was sending pause letters. The Fed was requiring pre-approval for everything. In that environment, the only money flowing into crypto was money that could operate outside traditional banking. Today, in April 2026, the OCC has given national banks permission to custody crypto, issue stablecoins, process crypto transactions as brokers, and participate in blockchain infrastructure. The FDIC has lifted notification requirements. The Federal Reserve has withdrawn its restrictive supervisory letters. The Genius Act is law. Coinbase, Ripple, Circle, and BitGo have federal banking authorizations. Goldman Sachs is disclosing $2.36 billion in crypto in its SEC filings. JP Morgan is accepting Bitcoin as loan collateral. Morgan Stanley just filed for a digital asset trust charter. The capital that could not access this asset class before because of regulatory barriers, fiduciary restrictions, and the absence of regulated custody infrastructure is now clearing those barriers one by one. The registered investment advisors who manage trillions in private client wealth and could not recommend crypto exposure without a compliant custody solution now have Coinbase National Trust Company, BitGo, and BNY Mellon offering regulated custody. The pension funds that required investment-grade counterparties now have Ripple Prime with its BBB KBRA rating. The institutions that needed regulated, liquid, exchange-traded vehicles now have spot ETFs for Bitcoin, Ethereum, XRP, and Solana with combined assets already exceeding $140 billion. The green light is not coming. The green light is documented, sequenced, and already flashing across every layer of the regulatory and institutional stack. The question the title asks, whether you are positioned, is the only question that remains. This is not financial advice. This is the documented regulatory and institutional picture. What you do with it is your decision. If this video gave you the framework most people are missing, hit the like button right now. That is how this reaches the people making positioning decisions right now with incomplete information about what has already changed at the institutional level. Subscribe if you want every major banking, regulatory, and institutional move in crypto broken down the moment it happens, because 2026 is the year the gap between the informed and the uninformed becomes measured in real portfolio outcomes. Drop in the comments which institution's entry surprised you most: Goldman's $2.36 billion disclosure, JP Morgan's collateral decision, or Coinbase getting a federal banking charter. Tell me below. And if you know someone still waiting for a signal that banks are serious about crypto, send them this video today. The signal is not a single announcement. It is 14 months of documented regulatory reversals and institutional filings that most people did not connect into a single coherent picture until now. Stay informed, stay positioned. The institutions already are.